about to drop the hammer and dispense some indiscriminate justice.
Welcome back, Strongman Personal Finance, everybody. I'm your host, Christopher Bell, certified public accountant, long-term Boglehead investor, author of the book, Stop Being a Broke Loser. It's on Amazon for $3. If you don't buy the book, you're a broke loser. If you do buy the book, you're suddenly not a broke loser. So go buy my freaking book, because I need that delicious ad revenue money. And I'm a hater of clowns, charlatans, losers, and degenerates on YouTube that pump garbage stocks and terrible investment advice. Now today, we're going to talk about China, as Trump calls it, China. So we're going to look at what I think is the best ETF to buy if you want to overweight China in your portfolio. Now, why would you want to overweight China? I don't know. Maybe you think China's stock market is going to do better than the market cap weighted stock market of the world. And if that's the case, you might as well tilt a little bit into China. Now, full disclosure, I do not own this ETF, and I have no plans to buy it because I buy total world stock market index funds and tax advantage accounts. But if you have the core of your portfolio in total world stock market index funds, but you're really bullish on China, maybe you can have 5%, 10% of your portfolio in this ETF. This ETF is the Franklin FTSE China ETF, ticker symbol FLCH. Now, let's go look at FLCH and let's look at VT, and I'll show you why China is very underrepresented in the total world stock market index. So there's actually this really cool website called ETFDB, I guess that's database.com, and you can actually compare ETFs head to head. So what I did was to demonstrate how small China is weighted, I compared FLCH, I guess that's what we'll call it, FLCH, versus VT. FLCH has 899 stocks, all China, and VT has 9,027 stocks from around the world. It's my baby. It's so delicious. So if we go down, they actually have these really cool comparison charts that really help put into context what you're buying. Now, the most important thing for here, I mean, you can look at the sector breakdown, et cetera, market cap. Basically, the most important thing is to compare the country breakdown. If you want to invest in China, this ETF, the FLCH ETF, is going to give you basically almost 100% China with a little bit of Hong Kong. I don't know what I just did there. If you compare that to VT, VT only has 3.34% of its entire portfolio in China. So like I said, if you're super bullish on China because they have a massive GDP, gross domestic product, but the market capitalization of their stock market is much smaller in comparison versus the United States, where we have a massive market capitalization versus our gross domestic product. If you want to overweight China, FLCH is the ETF to consider. But, you know, if you're happy with 3.34% of China in your ETF, that's fine, which is fine with me. I'm not overweighting China, but it's up to you. So what are some of the main reasons that I like this ETF? If you decide to overweight China in your portfolio, if you have more than 3.34%, you're overweighting China. Now, the reason I like this is because I fixate on expense ratios. When you're buying an index fund, you might as well get the lowest freaking expense ratio possible. The only main difference is some indexes, some index ETFs, index funds, they track different, I'm drawing a blank here. They track different indices. So each company like licenses and makes their own indices and they can like sell them to other people for revenue. This specific index is a little bit different than other ones, but what I like about it is that overall, you're only paying 0.19% per year. I was looking at other China ETFs and they're like 0.5%, 0.7%, 1%. So if you buy another ETF, you're going to pay, you know, between 5 and 10 times more in annual fees, which really stack up in the long run. So right off the bat, I fixated on this 0.19% gross expense ratio and net expense ratio. That is the biggest upside. Now, some of the downsides of this ETF it's not going to be as liquid as other China ETFs because the total net assets are only $124 million. I think the largest China ETF, I think it's a Morgan Stanley ETF, they have like $4 or $5 billion. So if you're trying to trade in and out of this ETF, which you shouldn't be freaking doing, then you might pay higher bid-ask spreads, which kind of, basically you'll be paying a little bit more and you'll be able to sell the stock for a little bit less than you normally would had you bought a more liquid ETF. That's just how it works. Now, another downside is look at the management. It's 2 women. I'm just kidding. I don't really care about the managers. What was another downside? Turnover ratio. Now, your turnover ratio is basically how often the holdings in the portfolio turn over. Now, I went ahead and pulled up their prospectus, and their turnover ratio is 32.47%. What that means is roughly 32.47% of the portfolio gets changed out every year. Now, if you think about that, that leads to additional fee drag because every time you buy and sell a stock, you got to pay capital gains taxes if there's a gain, and you have to pay bid-ask spreads. So the higher the turnover ratio, the more it's going to reduce your returns. Now, how you can mitigate this is by holding this in a tax advantage account. And if you're subscribed to my channel, you better be putting all your stuff in tax advantage accounts unless you absolutely need it before 59 and a half. If you don't need the money until retirement, put your freaking money in a tax advantage account. So that's one of the big downsides. It's just turnover ratio, but you can really mitigate that by putting that in a tax advantage account. Now, there's other ETFs that have lower turnover ratios, but the fees, in my opinion, are way too high, which more than compensates for, whatever additional return you're going to get from a lower turnover ratio. Now, why is the turnover so high? Well, this ETF tracks the FTSE, I think it's Franklin Templeton something, China Capped Index. Now, what this index is a free float adjusted market capitalization weighted index calculated by FTSE Russell. Now, the reason there's a little bit higher turnover is they don't let some holdings get too big. So here's kind of what they do. So they said no single issuer of a component exceeds 25% of the index. All issuers with weights above 5% do not cumulatively exceed 50% of the FTSE China Cap Weighted Index weight. So basically what they're doing is they're not letting some companies get too big in the index, which if you compare this to like QQQ, which is the US Tech ETF, that basically has more than half of its market cap in freaking like the top 6 stocks. So you're not going to get super overweighted. Now let's go look at the holdings of this ETF because I know that's what matters to you guys. And we're not looking at the previous returns because I don't care about past returns. I care about the future. If you look at past returns, you're probably a clown that doesn't know what they're doing. So anyway, like I said, the expense ratio is usually the biggest selling point. If you want to overweight China, if you want more than 3.34% of your portfolio in China, assuming you're in VT. Now the portfolio, if it actually loads, there we go. So you can look and get this freaking thing out of here. Some of the biggest holdings are Tencent, which comprises 13.68% of the portfolio, Alibaba 13%, Meituan 4.11%. So basically you have 2 very large companies, Tencent and Alibaba, that take up roughly, 26-27% of this index. And then basically everything else is spread out, 1% here, 2% here. But overall, this ETF holds 899 stocks. Let me verify that just to be sure. 899. Yeah, so to me, that's sufficiently diversified if you want to invest in China and you want to overweight it in your portfolio. So overall, I think if you want to overweight China, this is the best fund to buy. I don't personally overweight China because in my opinion, if China explodes, I'm just still going to capture those gains in VT without overweighting. And there's a reason that China's market cap, the market has decided that China's market cap should be so small compared to its GDP. So I don't think I'm a super genius that knows everything about the world. So I just let the world sort itself out because I own the Total World Stock Market Index Fund. But if you want to invest in China, I think this is the one to look at, or to at least consider looking at, just because the fees are so freaking low and everything else is so expensive. The only downside is the turnover. That's it, ladies and gentlemen. Did you like this video? Did I explain everything to you? Do you understand my methodology for choosing ETFs? Low fees, low turnover, generally, and then broad diversification. And you have to make sure that the index actually makes sense. But that's it. Like, subscribe, tell your friends about me. Y'all have a wonderful, delicious, superstitious, cockalicious day.